Previously, we recorded 10 transactions in the sample daycare example. We came up with unadjusted balances at the end of year 3. We recorded adjusting entries for sample daycare, and now we've got adjusted balances at the end of year 3, and we're ready to do financial statements. Hopefully you've been doing the problem with me and you have your handwritten copy of the spreadsheet in front of you. If not, you can print out a copy of this worksheet to use for the rest of this video as we go through the financial statement preparation process together. Which of the 4 basic financial statements should we start with? It's generally necessary that you start with the income statement, so we'll do that here. What's an income statement look like? Well, in its most basic, shortened, abbreviated format, it would look something like this right here. An income statement is supposed to reflect the results of operations for a particular accounting period. So it's very important to note that in the formal title of an income statement, the dating will read something like for the quarter ended, or for the month ended, or for the year ended if it's an annual financial statement. The name itself is not always income statement. You'll see a large variety on companies' actual financial statements. You'll see profit and loss statement, statement of operations, and many other variations on the title. You'll recognize the income statement basically because you'll see the format of the numbers, and you'll see that these things are included, in particular some computation of this bottom line. On the income statement, we list all of our revenue accounts, and then you would show a total revenue. You then would list your expense accounts with a total, and revenues minus expenses gives you net income. Now, you don't want to aggregate things this much because obviously there's not any detail if we were to do this for a user to get much useful information from the income statement. So you will actually see several different types of revenues and many different types of expense accounts show up on the income statements. If you look at the income statements of companies whose financial statements are readily available, you will see that there actually is a considerable amount of aggregation on their income statements. In our class, however, I want you to show all of the accounts that go into each one of these categories, and we'll see later on that there's many ways to rearrange the income statement and add subtotals in such a way that we'll be providing some additional information to the users. But for now, let's see if we can figure out how we would prepare a very simple income statement where we simply list all of our revenues, list all of our expenses, and subtract to compute net income. Where do we find these revenue and expense accounts that go on the income statement? In a formal accounting system, revenues and expenses are all recorded in their own separate accounts, temporary accounts, but those accounts eventually get closed or put back into retained earnings to make the balance sheet balance. In our simplified accounting system, we've actually recorded our revenues and expenses directly into the retained earnings account. So in order to do an income statement, it's a little bit messier. For example, we're looking for total daycare revenue. We see revenue was recorded here, but then an additional $3,000 of revenue was recorded down here. So we actually have to do some summary and some math. It's a very small company, a very simple situation, so it will not be too onerous of a job. Sample daycare will report. If they had a separate daycare revenue account, that account would have $53,000 in it. So we'll report daycare revenue on our income statement of $53,000. What kinds of things did we record in retained earnings? Well, we increased it for revenues, we decreased it for expenses, so we have various expenses here, and we put EXP for expense after all of them. The only other thing that got recorded in the retained earnings account was, of course, the dividend of $3,000. Remember that dividends do not fit the definition of an expense, so the dividend, even though it's here in this retained earnings column, is not going to show up on our income statement. Now sometimes if you look at corporations' income statements, you will see dividends on the same page where they've computed net income. That's just additional disclosure. It happens to be on the same page as the income statement, but you'll note that they are not deducting the dividend in their computation of net income. Pause and prepare an income statement on your own, then come back and compare to what I'll show you on the screen. Okay, here's the income statement for Sample Daycare. Again, notice the very important title. We'll have the name of the company, the name of the statement, and again, there's a lot of variation here. And then the most important thing here for you to note is the dating, because we want to compare and contrast the dates on these various statements. An income statement is showing you the results of operations for a particular period of time. In order for the information on the income statement to have any meaning, readers need to know what was the period of time. Is this net income for a week, for a month, for a year? What is it? So the dating is very important. This is Sample Daycare's income statement for a year. It happened to be the year ended 12/31 year 3. So this was our daycare revenue. We only had one type of revenue, so I wouldn't actually have to have a total number here. And then if you sort through that retained earnings column, you would see all of these as the adjusted balances in each one of these separate expense accounts. Revenues minus expenses gives us net income for Sample Daycare. The next financial statement that we'll prepare would be some variation of a statement of equity. For a corporation, you would normally see a statement of shareholder equity, or the simpler, smaller version that we're going to prepare right now for Sample Daycare, that's simply a statement of retained earnings. A statement of shareholder equity reconciles all of the equity accounts. A statement of retained earnings just reconciles the retained earnings account. What's the basic format for a statement of retained earnings? Well, I think we've seen this before, but let's go over it again quickly here. Remember, our purpose is to simply give users information about what changed retained earnings from its beginning of the accounting period balance to its end of the accounting period balance. So we know that Sample Daycare started out year 3 with a balance of $5,800 in retained earnings. It ended year 3 with a balance of $16,500 in retained earnings. We can see that very clearly because it's right here in our retained earnings column. What changed retained earnings during the year? Revenues, expenses, and dividends. Statement of retained earnings combines revenue and expenses into the net income number. That's what the NI stands here for. And it says, it's basically these 4 lines. It can get more complicated, but for us, for now, it's just these 4 lines. Beginning balance in retained earnings plus net income, and then of course subtract this dividend. This is where the dividend shows up. That gives you the ending balance in retained earnings. For us, because of the style in which we recorded transactions, we know that the ending balance in retained earnings is $16,500. If we were using a formal accounting system, remember that all of these revenue and expense and perhaps even the dividend amounts would have been recorded in separate temporary accounts. As a result, until we did closing entries, retained earnings would actually still have the beginning of the year balance in it, $5,800. Closing entries aren't generally done until after financial statements are prepared. And that's the reason why we prepare the financial statements in this order. We first do the income statement so that we can figure out what net income is. We then prepare some sort of statement of shareholders' equity so that we can figure out what the correct ending balance in retained earnings is. In the general ledger, we still see the beginning of the year balance in retained earnings, but by doing a little statement of retained earnings, we're basically computing what the post-closing balance in retained earnings will be. The balance in retained earnings after moving all the revenues, expenses, and dividends back into that account will be what we've done right here, because we basically have a post-closing balance. It'll be $16,500, and we know that it's going to take $16,500 in retained earnings to make the balance sheet balance. So this would always be the second financial statement that's prepared. This one will be easy. See if you can write out a statement of retained earnings, and we'll take a look at it together in a minute. Here it is. Looks just like we talked about. The math works. The beginning of the year balance plus net income. Net income came from our income statement minus dividends gives us our end of the year balance in retained earnings. This little statement ties together both the income statement and the balance sheet. The 13.7 of net income articulates or matches to net income on the income statement, and you'll see 16.5 as the 12/31 year 3 balance and retained earnings on the balance sheet. And generally, since you get a column that also gives you the prior year balance sheet, you would see 5,800 as the 12/31 year 2 balance in retained earnings. All right, well, let's now do the balance sheet. What's the balance sheet going to look like? Well, this one's the most familiar of all of them to you. The balance sheet basically is just the accounting equation. Of course, as we saw previously, there's a lot more detail than this. A company will list out the major asset accounts and give the readers a total of the assets. They'll do the same thing. They'll list out liabilities with a total for liabilities. They'll list out their equity accounts, and they'll give a grand total of liabilities plus equity. So the balance sheet is just basically showing a reader that the accounting equation is in balance. The balance sheet obviously does more than that. It shows a reader what all the resources of a company are and what the claims against those resources are. A very common title for a balance sheet is a statement of financial position. Again, there can be quite a bit of variance there. The balance sheet is dated differently than any of the other three financial statements. If you think about it, the balance sheet isn't showing you balances for a month or for a year. A balance sheet is showing you a snapshot of the financial position of the company as of a particular moment. So a balance sheet will just say at 12/31 year 3 or at March 31st 2013, whatever it happens to be. The numbers that we want to put on our balance sheet, of course, are just these end of the year adjusted balances that you have as the bottom line of your spreadsheet. So organize those into a balance sheet, and we'll take a look at one together when you're done. Okay, well, here's the balance sheet, or the statement of financial position for Sample Daycare. Notice the simple dating. It's just got the date, the at or as of, the end of whatever the accounting period happens to be. We see a listing of all the assets with a grand total of $70,200. We're showing here the net book value of the furniture at $16,600. We've taken the acquisition cost and subtracted the accumulated depreciation. This is a negative because it's a contra asset. When you go to do financial statements, there's no left, right, debit, credit. This inner column is only here to show that these two numbers are netted to come over to the $16,600 net book value. After listing all of the assets and giving a grand total, you see a listing of all the liabilities. I should have written here total liabilities. So these are all of our liability accounts. And then for a corporation, we only have two equity accounts. So common stock and retained earnings. Notice the retained earnings number here articulates back to the statement of retained earnings, which we would have had to do previously to get this balance if we used a more formal accounting system. Total of liabilities plus equity is grand total liabilities plus equity, and that will match total assets. So that's our balance sheet. Okay, The last financial statement that we'll be preparing for sample daycare is a statement of cash flows. A statement of cash flows is the fourth required financial statement. Statement of cash flows, similar to a statement of retained earnings, is really trying to just explain the change in a particular account during the current accounting period. And in this case, of course, the account is cash. What we're actually looking at here on the screen is the statement of cash flows for sample daycare. But right now I just want you to look at it for format, and then we'll figure out where all of these numbers came from later. Focus right now on the bottom part of the screen. So the bottom part of a statement of cash flows basically has this information. It says if the balance in cash at the beginning of the year, so this would tie to last year's ending cash balance on the balance sheet, was $2,300, and the balance in cash at the end of the current year is $5,700, and we can see these numbers right on our spreadsheet. The beginning balance was $2,300, the ending balance was $5,700. Well, then that tells us that cash changed during the year by $3,400. In this case, there was a net increase to cash of $3,400. Well, an investor can see that just by looking at the balance sheet. What the statement of cash flows attempts to do is give the reader more information about what generated that net increase or net decrease to cash during year 3. They do that by saying, let's give the reader some detail of 3 different types of cash flows: operating cash flows, investing cash flows, and financing cash flows. So to create a statement of cash flows, you basically say, well, I know this was my change in cash during the year. I'm going to bust up this change in cash into 3 different types of changes in cash. And the sum of an operating source or use of cash, an investing source or use of cash, and all financing source or uses of cash. The sum of these 3 things will equal the net increase or decrease to cash for a company. So here, operating, we had a net operating use of cash of 11,600. That's why that's a negative number. There were no investing cash flow transactions. And financing generated cash. There was a net financing source of cash of 15,000. So minus 11,600 plus 0 plus 15,000 is where the 3,400 came from. So what's really critical to preparing a statement of cash flows is just understanding the definitions of what's an operating cash flow, an investing cash flow, and a financing cash flow. And please note that the definitions of operating, investing, and financing that we'll be talking about in a few minutes, those definitions are particular to creating a statement of cash flows. For example, the way we define operating when we're computing operating income on an income statement is different than the way we define operating when we're computing operating cash flows for purposes of a statement of cash flows. So these definitions are very particular to preparing a statement of cash flows. Here's a short summary of the definitions that will work for our purposes here in this course. The easiest way to remember these, I think, and it's pretty much a memorization activity, but the easiest way to remember these definitions is to remember what qualifies as investing activities and financing activities, because there's fairly few of those, and then realize that everything else is going to be an operating activity. I like to think of it as, what if we were starting up a new business today? What would happen? Well, the first thing our new business would have to do is get financing. How does a business get financing? Well, they generally either borrow money or owners put money in. So if you're a corporation, a cash inflow that qualifies as a financing activity would be money that you get from issuing common stock. Alternatively, or in addition, a cash inflow from going to the bank and borrowing money would also qualify as a cash inflow financing activity. Financing activity cash outflows include when you repay principal amounts on debt. And then the sort of oddball one here, when a company pays a dividend, that's considered to be a financing outflow of cash. Kind of quirky and interesting, if a company pays interest, if they incur an interest cost on borrowed funds, the payment of the interest is not considered to be a financing activity. Rather, it's included along with operating activities. So the borrowing and repayment down here under financing activities only includes principal amounts. And again, that's more definitional than it is theoretical. So our brand new company now has funds. The shareholders purchased some stock. We borrowed some money. What's the next thing we have to do to get our business up and running? Well, we probably have to go out and participate in some investing activities. And in particular, the one that you'll see in this course would be we'd need to go out and purchase property, plant, and equipment type assets. So the most common type of investing activities are the cash inflows or outflows from purchases and sales of property, plant, and equipment type assets. The category generally includes purchase and sale of all long-term assets. So if you buy property, plant, and equipment for cash, that's an investing activity outflow. When you sell your property, plant, and equipment for cash someday, that would be an investing activity inflow. It's not just property, plant, and equipment that's included here. It would also be long-term investments in things like stocks and bonds of other companies. But early on in this course, we'll just refer to property, plant, and equipment as the easiest example of this type of activity. Everything else, everything that doesn't go into investing or financing, is an operating activity. So operating activities include, collection of cash from your customers. It includes payment of wages, payment of rent, payments for inventory. And realize that when you're doing a statement of cash flows, if you don't care if a company pays rent for 3 months or for the current month or for 3 years, it's whatever they pay as rent is going to be a cash outflow operating activity. Okay, well, let's go back. Take a look. Let's go back to the sample daycare worksheet and look in the cash column. And for each transaction that involves cash, because remember, the first thing is it has to be a cash transaction. For every transaction that involved cash, look back at these definitions. You can pause it here so you have these in front of you, and classify each cash transaction for sample daycare during year 3 as O for operating, I for investing, or F for financing. It'll be very obvious whether it was an inflow or outflow of cash, because you'll clearly be able to see if you were increasing or decreasing cash on your spreadsheet. All right, so let's look back here at our cash column. The $2,300 is the beginning balance in cash. $5,700 is the ending balance in cash. We don't assign an O, I, or F to those, because those are beginning and ending balances in cash. But the $6,000 in number 1, through all of these transactions in number 7 and then 9, all of those are cash transactions. So you might have to go back and look at the original problem to remember what these relate to, and then that will tell you whether to label it O, I, or F. $6,000 was cash received from customers for daycare services, so put an O next to the number 1 or next to the 6,000. The $10,000 was an inflow of cash from borrowing from the bank. That would be a financing or F transaction. The $23,000 in number 3 was a payment for the current year's wages. That's neither financing nor investing. That's an operating transaction. So 3 is operating. 4 is the dividend. That's a financing transaction. 5 is cash receipts from the issuance of stock, another financing transaction. 6 is when they received $12,000 from a customer. It was for services that would be provided part in the current year and part in a future year, but we don't care about that. We're all about the cash right now. That's an operating cash inflow because it was cash received from a customer. In 7, the company pays $3,600 for a lease. Again, we don't care if the benefit's used up or not. As far as the cash flow statement goes, that's an operating outflow of cash. Okay, it's operating because we're just renting. We don't own the property. There's nothing to do. In 8, they purchased $2,000 of office supplies on account. We don't record any cash flow effect until they actually pay for those supplies. And that's what happens in number 9. In number 9, the company pays $3,000 on account, so they're paying off accounts payable. That would be an operating cash outflow. So now you've got all of these designated, and basically what you've done is just designate where these numbers are going to show up on the statement of cash flows. Let's go back and take another look at it. This time we'll start at the top. Notice the dating. The dating is the same as the income statement and the statement of retained earnings and the statement of cash flows. All three of those have the same dating. The balance sheet again was the oddball. These are the things that we decided were operating cash flows. I have the inflows as positive numbers, the outflows as negative numbers. We have a net use of cash or a net outflow. We didn't have any investing transactions in this case. We had 3 different financing transactions. They're detailed here. They add up to $15,000, and as we've already discussed, the sum of our operating, investing, and financing transactions have to add up to the change in cash during year 3 of $3,400. Now this statement of cash flows that we just prepared is a statement of cash flows prepared under the direct method. The direct method is fairly intuitive for a reader to understand, but it's very uncommon that companies will use this method in their financial statements. Companies are allowed to use either a direct method or an indirect method to present this operating section of their statement of cash flows. Later, when we look at how financial statements can be made more useful and how they're, the types of subtotals and presentations that companies generally use, we'll also take a look at the indirect method of statement of cash flows. You'll know you're looking at an indirect method statement of cash flows when the operating section has a first line that says net income. Under the indirect method, companies compute operating cash flows by starting with net income and then doing a series of adjustments. If you start with net income and do the correct series of adjustments, you should of course end up with the same operating cash flow, in this case of a negative $11,600. For now, what I'd like you to know is what qualifies as operating, investing, and financing transactions, and basically understand the structure of the statement of cash flows.